Sorry, baka may ano ba tayo? So as John had introduced to everyone, we are in this research study, we aim to assess or have an investigation of whether the interest rate corridor system of the BSP was effective in lieu of its objectives and the rationale for the interest rate corridor when it was first introduced in June of 2016. Now, um, in theory, money market rates and treasury bill yields are expected to be at a premium over overnight policy rates because this reflects term liquidity and credit risk and other counterparty risk factors. This relationship actually reflects the main transmission mechanism of monetary policy, which is the interest rate channel, and it remains as the key transmission channel of monetary policy in emerging markets. And this was found by Mohanty and Turner since 2008. However, it is possible that other channels of transmission are at work, such as the lending rate channel. And this is true during periods when there is a large gap between the policy rate and benchmark interest rates. This is a topic of another study, which we will be presenting later on in this Research Huddle series. Next slide, please. What is a corridor framework? Just as an introduction, a corridor operating framework can help a central bank achieve a policy rate in an environment where reserve requirements may not be binding, perhaps due to low or non-existing reserve requirements, or perhaps when the use of the central bank's balance sheet as a policy instrument um, sort of makes at certain periods makes the policy interest rates influence over market rates weaker. In practice, the corridor system has effectively stabilized the policy rate near its target rates. It's in a number of countries. We actually have a review of the different countries which are already practicing the interest rate corridor framework. The most recent of which, and which was actually encouraged when the BSP began implementing the interest rate corridor, is Bank Indonesia. In fact, they had consulted the BSP DER at an earlier date prior to the implementation when they've heard that the BSP is interested in implementing an IRC or the interest rate corridor. Next slide, please. So mainly, a corridor system should limit volatility in the policy rate and should be able to isolate interest rate policy from the size of the balance sheet. In a corridor system, as in the traditional framework, the central bank chooses a target for the overnight policy rate, which is consistent to its goals for inflation and economic growth. So, in the case of the BSP, for example, it is coming from forecasts that is developed within the monetary policy making process, and the key players for which would be the technical secretariat of the advisory committee of the Bangko Sentral. And at the same time, the central bank supplies a certain level of reserves to the banking system, and it can influence this through its open market operations. So the central bank establishes a lending facility, and this is similar to the Fed's discount window, through which it stands ready to supply whatever amount of overnight balances are demanded at a fixed rate. So in a sense, the interest rate is set above the target policy rate to impose a penalty on depository institutions that borrow from the central bank rather than in the interbank market. So what this statement is saying is that essentially you have some interest rate that's at a premium over the policy rate because you want them to be penalized if they choose, in a sense, be penalized if they choose to borrow from the central bank market rather than be active in the financial system. The final element of a corridor system is establishing the overnight rate, or in our case, the RRP rate. With the ceiling and floor established, then the corridor defines or limits the fluctuations in the overnight policy rate. So this description is coming from Khan in 2010. Next slide, please. Zeroing in on exactly how the BSP practiced or implemented the IRC. So again, this was implemented specifically in June of 2016. So these four bullets represents the rationale or the main objectives when the interest rate corridor was decided upon by the BSP. First, the IRC system is expected to improve the BSP's ability to guide market interest rates. So again, the main objective, at least in this first bullet, is for the policy rate to have a stronger bite, so to speak, in market interest rates. Second bullet is looking at the IRC to help limit volatility in short-term interest rates. So later on, I will be showing a chart that would depict some stylized facts that would show you why and what it means when we say we want to limit the volatility in short-term interest rates. A third and fourth objective that is not going to be the highlight of this study is that the IRC is also seen to eventually encourage banks to borrow and lend in interbank market rates and in turn strengthen the price discovery process. So the idea is that with the IRC system, when the policy rate has more influence or a stronger influence in guiding market rates, and when the IRC is able to limit volatility in short-term market interest rates, this is seen to help develop the Philippine capital markets further. So financial deepening is what is the objective in mind in this particular, in the third bullet or in this particular rationale. And a fourth bullet is that over time, the IRC should allow a further reduction in reserve requirements. Of course, in lieu of our recent decisions, in effect, this has been started, or the reserve requirement rate has already begun the process of uh, reducing it in the long run, making it more at par with our ASEAN or Asian in general central banks. Next slide, please. So this is what I was describing earlier, just to look at some stylized data on the Philippine financial markets. This is a chart showing us the different interest rates in the market, in the domestic market. And the green line is the main policy rate. The dotted red line is the 91-day Treasury bill rates. The red line with the triangle markers is interbank call loan rates. And we have two specific types of lending rates, which we will also be using in this study, which is the low quoted lending rate and the high quoted lending rates. The low quoted, now being quoted rates, these are just the published rates by the banks. They are not the actual rates, although the industry-wide actual rates are available on a monthly basis. The bank level actual rates are, however, not as readily available, but the quoted rates are. So this is the reason why this is what is being used in this study. And it is the quoted rates which are available on a monthly basis and bank level. So the low quoted lending rates represents rates that are for relationship-based lending. So it's more for the prime lenders of the banks versus high quoted rates are, should we say, a more, we can term it subprime type of borrowers. This is what the banks would charge subprime borrowers. And so when we look at these, especially in the beginning of this particular chart, between 2001 and 2007, you can see there is a very high level of volatility. I mean, even onwards, we still see that level of volatility, although all of the rates have started to go down in terms of direction. But within this particular group of market interest rates, you do see volatility and volatilities that are not even within the range or following the guide or the direction of the policy rate. So, ergo, that is why there was this motive or motivation for the Bangko Sentral to work out and implement an interest rate corridor system. If I may approach the chart, so we see it here that despite very stable policy rate, we see the T-bill rates. This is the period right after the GFC, wherein we find T-bill rates even approaching zero. So investors are willing to purchase T-bills even at zero rates. So it must be play on the exchange rates, but that's for another story. But the idea is that the Bangko Sentral wanted to have some stability in these rates in the market. Next slide, please. Sorry, before that, no, this is fine. The slide is fine. In the interest of time, we have thought of, or the group have thought of three different methodologies to answer the question on the two objectives that we highlighted earlier. So first is the effectiveness, or sorry, the strengthening the influence of the policy rate. And the second objective will be tackled by two other methodologies. So for the first objective of the interest rate corridor, and that is to strengthen the influence of the policy rate over market interest rates, we have decided to make use of panel generalized method of moments model um, that is covering the period 2008 to 2019. And we are using the high quoted lending rates and the low quoted lending rates of 32 UKBs as our dependent variable. So, the idea here is we want to see whether the influence, the degree of influence of the policy rate, has it strengthened over time? Has it strengthened during the IRC, which is 2016 to 2019? Is the magnitude of influence stronger versus the earlier period? And we also want to see what is the degree of influence when you look at the entire sample in our study. So these are some initial findings. In order for us to sort of gauge the influence of the policy rate vis-a-vis other instruments, so we've included in the right-hand side as an explanatory variable, not only the own lag of the two lending rates, but as well, and not only the main policy rate, the RRP rate, but we've also added on the right-hand side the 91-day T-bill rate as one market rate. And we just added GDP growth and inflation just to have sort of a control on macro variables that also affect uh, um, the decisions of banks in setting their lending rates. So we have four different specifications, just changing the market rates that we are looking at and the sample period. So first specification is the full sample period of 2008 to 2019, whereas specifications 2 to 4 is for the sub period during the interest rate corridor, which is 2016 June or MO6 to 2019 M12 or December. And specifications 2, 3, and 4 are looking at the 91-day T-bill rate, and then against the policy rate, and then the 91-day bill rate along with the 28-day term deposit facility rates. And the fourth specification is looking at the 91 T-bill rate against the term deposit facility 7-day rates. And then, so this is both done for the high quoted lending rates and the low quoted lending rates. Next slide, please. Just to summarize the numbers shown in that table, and in the interest of time, we found, at least in the preliminary results, that the RRP rate now termed as our overnight lending facility rate, was the rate that is consistently a significant driver of bank lending rates for the given sample of 32 UKBs. So this is both for the full sample period and for the period during the interest rate corridor system. In terms of the degree of influence, as represented by the coefficients that we arrived at from the estimation results, the RRP rates also remain to have the strongest influence among the three other interest rate variables, followed by the overnight deposit facility rate, which we also tried in a separate specification over the full sample period. So the third bullet is one important finding. The 91-day T-bill rate as an explanatory variable is significant only when one considers the entire full period 2008 to 2019. When for the estimation that is for the subsample during the interest rate corridor, we found that the 91 T-bill rate is overall either insignificant or is significant but has the wrong sign or even both, and obtains the lowest coefficient when evaluated among the four different interest rates being tested, and that is the RRP rate, the TDF 28-day, and the TDF 7-day rates. This is the case both for the high and low quoted lending rates. So from those preliminary results, what is interesting is that it seems that while the lending rate channel is strong, the influence of the policy rate is strong in the lending rate channel, it seems that there is something more going on in the interest rate channel because the 91-day T-bill rates appear to be insignificant in the decision-making process of banks in setting their quoted lending rates. Of course, we have various other studies that try to answer that, but what is clear, at least in this particular empirical exercise, is that during the interest rate corridor system, the degree of influence of the main policy rate remains strong and significant in influencing lending rates. Now, of course, again, that only answers the first bullet or the first objective of the IRC. The second objective will be covered by two other methodologies, which my two other colleagues will be discussing with you. Vic, the floor is yours. Thank you.
Can you go to the next slide? Next slide. Okay, so in the first method, we try to answer the question: did the influence of the policy rate strengthen with the BSP's adoption of the interest rate corridor? Now, there's another question that we posed and we want to answer, and the question is: did the IRC reduce interest rate volatility? Now, to answer that question, we will be needing to undertake other empirical exercises, and we've chosen two actually. The first one is the Google causal impact, and the second one is interrupted time series analysis. The first one is named Google causal impact because it is actually developed by Google, by economists from Google, and that's the term Google causal impact. Next slide, please. Now, estimating the causal impact of any policy is econometrically hard. It's really hard. And although it is a valuable indicator of its effectiveness, and that's the reason why when the BSP adopted IRC, you would be asked several times, were the BSP successful when it implemented interest rate corridor? Well, it's a question that you cannot answer right away. You have to empirically check first. Okay, so that's the reason why it's important to determine the causal impact of the interest rate corridor. Now, traditionally, when you estimate causal impact, you make use of randomized control experiments or RCT, such as those studies by Doflo and Banerjee. So this is the most ideal, the most conventional. And these methods are utilized to estimate the potential outcomes and average treatment effect properly. Or ATE, we refer to as ATE. ATE is simply the intervention's causal impact. So we want to know the causal impact of the interest rate corridor. However, in practice, this is quite challenging. I mean, estimating the causal impact of the interest rate corridor on, let's say, the volatility of the short-term market interest rate is challenging to say the least. Because when you apply causal impact, when you apply the RCT methodology in central bank policies, you will be encountering ethical considerations, difficulties in controlling for unobservable events, and violation in the stable treatment value assumption. That's the reason why, next slide, in other studies, they utilize the difference in difference methodology. However, the method is also flawed in a time series setting. Broderson et al., the developers of Google Causal Impact, pointed out several limitations of the DID methodology. The first one, according to them, is that the regression assumes that the data are identically and independently distributed despite the temporal component of the data. The second one is that it considers only two inherent time periods. So you have the pre and the post-treatment. And then finally, DID methodology, it's flawed because restrictions are imposed on the way synthetic controls are constructed for the DID implemented in a purely time series data. So what you need to do is you have to overcome the DID framework's shortcomings, and Broderson et al. Propose a state space model with a highly flexible regression component to explain an observed outcome's temporal evolution. So the challenge actually here is to create a counterfactual. So how do you create a counterfactual? Because when the BSP adopted interest rate corridor, it cannot go back. It cannot. I mean, once you implement IRC, you are already in the IRC. You cannot. You can no longer observe the counterfactual, meaning before the IRC, when you are already implementing the IRC. So following, can you go to the next slide? Following Abadi, Diamond, and Heinmuller, Broderson et al. Construct the counterfactual by creating synthetic control. A synthetic control is formed by combining candidate predictor variables into a single synthetic control. The potential predictor variable should be picked based on the series predictive power before the intervention is measured. Now, you might ask, how do you do this operationally? So, how would we do this operationally? So, in our study, we will be looking at the volatility of the short-term market interest rate, the 91-day T-bill. Okay, so we will be constructing counterfactual. How do we construct the counterfactual? Well, we will be looking at the equivalent short-term volatility of interest rates of selected ASEAN countries. So from there, we will form the counterfactual. The prospective predictor variable, or we refer to as coverage, should not be affected by the BSP's interest rate corridor. Now, it is important to note that while the selection of the coverage is based on its pre-treatment characteristics, their value for predicting the counterfactual lies in its post-treatment behavior. So how do you go about it? Let's say, for example, we're looking at the short-term market interest rates, the volatility of short-term market interest rates. So what you need to do is to create the counterfactual. You have to first know the you have to first conduct a correlation of the several short-term market interest rates, the 91-day T-bills. And then for those with high correlation with the Philippine 91-day T-bill, you will be utilizing them as your covariates. So that will form the counterfactual. Next slide. Okay, so Neil will explain the Google causal impact and the interrupted time series analysis.
Thank you, Sir Vic and Ms. Lau. So, the reason why we chose the Google causal impact and the interrupted time series analysis, or ITSA, is because of the following advantages. So, number one, the Google causal impact is fitted using a Bayesian structural time series model to set to a set of target and control time series observations, and subsequently performs posterior inference on the counterfactual. So since because of the limitation of our data wherein we cannot anymore observe data points wherein there are no IRC because we're already in an IRC environment, the Google causal impact can address this kind of limitation. At the same time, it employs a probabilistic approach to modeling a time series problem, namely the return a posterior predictive distribution over which we can sample to provide not only the forecast, but also a means of quantifying model uncertainty. So with this, the Google causal impact can also address the uncertainties behind what are the nuances or what are the things that are not correlated with the IRC anymore. So that's the reason why Google causal impact can be a viable methodology for addressing the objective number two of the IRC system. Next slides, please. So as mentioned a while ago by Sir Vic, there are limitations to the DID model, wherein we just observe two periods, the pre and the post-treatment periods. However, because the IRC and the BSP's interest rate as well is moving across time, we cannot actually use the DID anymore, or even the RCT, or the randomized control trials. That's why we also chose to use the interrupted time series analysis. Essentially, we will just compute for the volatility of the short-term interest rate and then introduce at a certain time where the IRC model comes in the system. So with this, we can actually predict or actually measure the impact of the IRC system in terms of reducing the volatility in the market. So next slide, please, and the last slide. So these are the sample outcomes of what we think, what we can see using the Google causal impact and the ITSA. So in the Google causal impact on the left-hand side, you could see that there's the original and the point-wise predictions of the Google causal impact. At the same time, we could also see at the bottom part the real impact of the policy or the program that we're trying to measure. For the interrupted time series, on the other hand, we could actually predict what should be the impact of the IRC when it is not affecting the time series model. At the same time, we can also see the projection of the observed trend when the IRC is already implemented. So with this, we could actually see and actually measure how the IRC can address the volatility in the market. So this is the end of our presentation, and we are hoping for your kind comments and suggestions. Thank you.
Thank you, presenters. The floor is now open for questions.
So you're still working on this, and have you written it up yet? Not yet. Okay.
We have preliminary results only from the first methodology. So we have uh, some introduction and a few related literature, but we're still developing the second and third methodology
So in process.
in process po.
Sure, Francis is waiting for it.
Vic, forgive me for my question. So following the title of your paper or your presentation, so in a nutshell, how effective is the IRC?
Sorry, Ferdy, wala pa akong estimates for the IRC, but I can give you, can you go to the sample outcome? Okay. Last slide. If you look at the sample outcome, this is actually an actual study I did several years back for a subject in my PhD. So there, I'm trying to determine the causal impact of BSP's adoption of interest rate targeting on the inflation rate. So this is actually the causal impact of inflation targeting on the inflation rate. So here the data that I use is from 1995 to 2015. And then if you look at the graph, the panel, the chart which has three panels. On the first panel you see the original, and then on the second panel you see the pointwise. If you look at the first panel, you can see on the black line, that's the actual inflation rate, and then the blue line there, okay, so would be the estimate of the counterfactual. So actually, if you take the difference between the observed series, meaning the actual inflation rate, you deduct the counterfactual, which we estimate using the Google causal impact, then you will see the estimate of the causal impact. In this example, uh, let me see the exact figure. Okay, so actually in that chart, during the intervention period, the inflation rate had an average of approximately 3.97%. By contrast, in the absence of intervention, we would have expected an average inflation rate of 7.45%. And if you subtract this prediction from the observed response, yields an estimate of the intervention's causal effect on the response variable. The effect is negative 3.48%, which suggests a reduction of around 348 basis points in the inflation rate. The above results are given in absolute terms. In relative terms, the inflation rate showed a decrease of negative 47%. This means that the negative effect observed during the intervention period is statistically significant. So that's for the causal impact of inflation targeting on the inflation rate. So if you're going to ask me that question, we can easily answer that by estimating the causal impact using the Google causal impact. And this will also be complemented by the other methodology, the interrupted time series analysis. Because the two are they're almost similar in their approach.
For example, I am an ordinary guy in the street. So based on your preliminary estimate lang, if you're going to evaluate the effectiveness of IRC at a scale of 1 to 5, how would you rate?
Ay, wala akong scale na may bibigay. Pero ganito na lang. Kasi ang maganda, the beauty, the beauty of the methodology is that you can visualize the result. Okay, so you can easily visualize the results. And in our study, what we intend to show would be the causal impact of the BSP's interest rate corridor. So you'll be seeing the volatility. So kung makita mo na you see a drop in the volatility of the market in the 91-day T-bill. So in that sense, the policy of the IRC was effective.
If I may add and try to also respond to for this question, please show slide 12. So graphical, at least for a more lame. Sorry. So naiba pala. This is 12 in my slide. Maybe before this, sorry, Meg. Yung meron akong chart na yan. So Um, this is a graphical representation of what has happened. This basically is our corridor over time. So if you can see in the beginning, so hindi pa, nakalabas pa siya. But when we make a close up in from 2020 to 2021, so for updating pa for 2023 itong chart na to. But this is up to I think this was October of 2021. You see here, ito, from here nasa loob na siya. So ito, this blue dotted line is actually the BSP T-bill, BSP bills, rather, our own CB bills. This was introduced in September of 2018. So nung time na to, siya naman yung bago, kaya hindi pa siya nakakapasok sa loob. So at least graphically, it shows that, in that sense, na-achieve naman yung ganong klaseng, yung na-envision originally, at least by 2020 to 2021. And of course, our next or in our succeeding presentations, we'll update this. So again, this is a graphical analysis. Our further methodologies 2 and 3 will give us a stronger and more robust result, wherein you, as Vic had presented earlier, in terms talaga of how much volatility had declined due to the IRC itself and the implementation of the IRC. Thank you.
This is a kind of a moving target, di ba? Because like this week, BSP announced the variable rate format, the auction. So will you be able to string the data together so that you can continue to build this, methodologically speaking? I'm wondering.
Let me start to try to respond to your question, MBM, but my other colleagues can also follow up. Given that it represents a change in the way that we are auctioning our RRPs, I think it would entail some treatment, statistical treatment, because you're actually not comparing apples to apples, as they would say, because the variable rate represents a major change, and I think we would see quite a movement, and we would need additional data points as well to again assess the sort of the overall impact of that change in our monetary policy framework. So maybe po not straightforward or not directly, but over time, if we are able to gather enough data points, then baka pwede uling mag-counterfactual analysis.
The minimum represents a break.
Sir, ideally, when you use the interrupted time series analysis and the Google causal impact, ideally you should have equal observations on the before and after the intervention. So in the case of the variables, sir, that would be another intervention. So it would be another a causal impact estimate of this time the introduction of the variable auction rate.
We want to remind our online audience that they can just type in their questions in the chat box. So the question is from Mr. Archie Gallo. With the integration of new data, will there be changes in terms of level and trend in the ITSA graph presented earlier?
Thank you, Sir Archie, for that question. So technically, yes, there will be changes in terms of the level and trend depending on the new data points. As mentioned by Sir Vic, there should be an equal number of counterfactuals and observe new trends after the IRC system. So in this case, if we want to measure the impact of the IRC in the future, we need to rerun the model. So with that, we could actually check the real impact of or measure the actual and quantify the actual impact of the IRC system. So technically, yes, yes po.
Can I just add, but it's actually best to estimate the causal impact almost right away or a few years after the implementation because there are so many things happening. You cannot just attribute that to a single policy. So for example, in the case of the IRC, for example, maybe if we introduce the variable rate, that would be another topic of another research, not IRC anymore because it's going to be very hard to pinpoint and say exactly that the reason for the decline in short-term volatility is because of the IRC, when in fact the BSP introduced other measures other than the IRC.
Any more questions? There being none, this now concludes our presentation for today. We would like to thank the audience, both here, the floor, and online, and our presenters, Dr. Fermo, Mr. Delloro, Mr. Lomibao. Thank you very much and have a nice day. Everyone to the next version of the BSP Research Huddle next week. Coffee will be served and as well as snacks.